So the rate dropping, but still an eye-watering figure. You know, that's still going up 16.5% in terms of what
it's
you're buying.
It's just going up less quickly.
Yeah.
And the Cantor numbers, you know, very authoritative numbers. They are a long-standing consumer survey consultancy. They tend to be a little bit lower than the official ONS numbers. When Cantor were at 17.5% food price inflation in April, the ONS, the Office for National Statistics, was at 19.1%.
Yeah.
So if Cantor are still saying 16% since in May and into June, then the ONS number's still going to be like 17 or 18%, which suggests... Mark, when the headline inflation number comes out tomorrow, food is going to loom large. That's a big proportion of what we all spend. Is that headline number, it's 8.7 in April, is it going to come down to what? 8, 7.5? And what's still very high.
What's causing this, or what would term the supply side, in terms of, you know, the goods coming into the shops and the transport and all the other? What is, you know, still getting this double-digit figure each month?
So some people, specifically on food price inflation, which of course is driving the behaviour at the food bank, a 20-fold increase in food bank use. And I've talked to Neil Sharlick since GB News began. He's one of the first people I had on my show on GB News, On the Money. And I really trust him. I think he's... I don't think
he's at the sharp end.
I don't think he's making the figures up at all. I've seen his books. It's very well run food bank. And, of course, food price inflation is driving that big increase in use. And food price inflation is partly, I think, because some of the retailers are chancing their arm and being a bit opportunistic, but also food... retailing, the cost base relies not just on the price of the food, and food prices have come down a bit, but it comes down with a long lag, because food was grown last year when fertiliser was very expensive, fertiliser prices have come down.
Polytunnels, very expensive heating and so on.
All of that. Energy prices, as you say, remain high. There's a lot of transport costs in food, there's a lot of processing costs, there's a lot of labour costs. So even if headline wholesale food prices are coming down, there's still a lot of food price pressure in the supply chain. So when this number comes out tomorrow at 7 a.m, this inflation number, and I'll be here in the GB News studio, I do expect food price inflation to remain high, even if energy price inflation comes down a bit more. So it seems we're looking, as a headline number, somewhere between 7 and 8%, which means it's going to be very hard for the Bank of England not to raise interest rates on Thursday by at least 25 basis points, from 4.5 to 4.75, and maybe even by 50 basis points.
And we'll have a lot of people scratching their heads thinking, what is the point of what we call monetary policy, high interest rates, in terms of squeezing things out of the economy, when we've already got people going to food banks because they can't afford to go to the shops to buy food?
Absolutely right. And another argument in the same vein is, if you increase inflation, if you increase interest rates, then people's housing costs go up, which adds to inflation, and also firms' costs of servicing their debt go up, which are then passed on to consumers, which adds to inflation. But on the other hand, if the Bank of England doesn't raise interest rates when the markets expect them to, sterling will fall, then our imports will become more expensive, and we import a lot of stuff, not least a lot of food, and that will add to inflation. So the Bank of England, having been remiss in a lot of its communication, in my view, having been slow off the mark to start raising rates, is between a rock and a hard place.
And are they looking over their shoulder at the money markets, in we talked about gilts, which basically have a direct effect on interest rates in terms of borrowing from banks and building societies for your mortgage? They're edging up again.
They absolutely are. Let's have a quick look at some graphics, Simon. Sorry, Mark. Sorry. Let's have a quick look at some graphics. So if we look at the path of interest rates, these are Bank of England interest rates.
That's the base rate.
Yeah, you'll see back to 2017 to 2020, rates were ultra low. So 5, 3 and 2 years on, these are what mortgage deals are usually fixed at. Those ultra-low rates are now expiring if you've got a 5-year, a 3-year or a 2-year deal. And so as you have to remortgage now, you're having to remortgage not at those ultra-low rates, but at interest rates that are higher than the Bank of England's interest rate, 5%, 6%, maybe 7%. And that's driven by the fact that the government is spending more borrowing because people are worried about inflation, and that's pushing up base rates, and it pushes up mortgage rates too. What are the implications of that on those mortgage rates, let's have a look at the next slide to see how much it's changed. Back in June 2021, you'll see there the average 2-year fixed rate mortgage, the average house price, the average loan to value, just 1.91%. It rocketed after all that inflation in 2022 to 5.07% in February this year. Now, the average mortgage rate for 2 years is above 6%. And what does that mean in terms of pounds and pence? Well, the average mortgage, I've worked it out, is 759 quid a month. As people come out of those fixed rate deals, it's going up to 956. That is an extra $2.5 grand a year.
And that's on the fixed rate. If you're going to a variable rate, thinking, oh, let's just wait and see what happens on fixed rate, you're going to be paying even more, what, 7.5%?
Potentially, but the thing about the variable rate, you'll have got there slowly. Right. So if you've stuck on the variable rate, you can probably handle it.
The escalator's a bit...
It's people... Many sensible people, the majority of people, have been on fixed rates, and those fixed rates set at ultra-low levels are now unwinding, and
so people face
the full force, Mark, of that jump that they weren't previously exposed to. And that's why I've been calling for the last month for the Bank of England not to raise interest rates. I wrote that in the Telegraph 4 or 5 weeks ago. Don't raise interest rates anymore. Let the implications of the ones we've already had work through. Yeah. And I don't think the Bank of England will take my advice, because I don't think they can afford to, because if they don't raise rates, the money markets will hammer them.
Yeah, and then, of course, the other problem is we can't afford the interest rate when it comes to in terms of mortgage and everything else. Anyway, tomorrow and Thursday, big days. Liam, for the moment, thanks very much indeed for that. We'll keep you updated, of course, here on GB News.